Well, hey there, everyone, and welcome to today's VIP Trade Room with Roger Scott and Matt Horton. My name is Raleigh White, and I'm coming to you live from another beautiful day here in Austin, Texas, and I'm going to be your moderator today. Now, in today's session, Roger is going to be covering a range of important topics with a continued focus on credit spreads, including part two of credit versus debit spreads, how to set up an iron condor, which is a two-sided credit spread, what the best technical levels are when you're considering a credit spread and iron condors, why iron condors give a 2-for-1 margin and risk requirement, how to manage credit spreads and iron condors if and when they go against you. And from the mailbag, a question was asked, how do we exit these small cap stocks that Roger shares with us every morning? So for those of you, once again, if you've got any questions during Roger's presentation, remember, folks, that you can always put your questions in the chat window and we'll address them periodically throughout the session so as not to interfere with Roger's presentation. Also want to remind everyone that the chat is open to everyone. So remember, we've got some ground rules. Number one, always be kind. Number two, keep to the topic. Number three, no political discussions allowed. And number four, and most importantly, remember that we are a 100% supportive trading community here to help each other to become more confident and consistent in our trading activities. Now, if you were with us this morning during the pre-market open show, Roger shared several things with us that are important. Number one, when looking at catalysts, it was kind of a light day. He said, keep an eye on tech because we saw that Oracle was up 1% in pre-earnings upgrade. In other words, Oracle scheduled to release earnings later on today, but there was an upgrade and they were already up 1% on that. So for that reason, it makes it on board as a catalyst, especially when you consider how big they are as a company. Secondly, we see that Dell is down 1%. So for those two reasons, keep an eye on tech. Also, keep an eye on retail because Dick's was up about 1%. Now, once again, they're not so much of a biggie, but as Roger says, when it comes to the consumer discretionaries, typically when you see one stock performing well, it tends to lift the sector. And lastly, he said payroll, because at 10 o'clock this morning, we saw a revised payroll revision come out, which basically lowered the number of jobs that were created by 900,000 in the period towards the end of 2024 and into 2025. Something definitely to keep an eye on. Now, as far as Roger's small cap watch list is concerned, I am going to go ahead and copy and paste that in here for you so that you each can see those. Let's see, here we go. And it was interesting this morning because the number one there, CWD, I think Roger initially, I look at my notes here, I think when Roger was initially looking at this, it was somewhere like around $14.90. And then it was revised to $24. And then it was revised up to $31.05, all to point out the fact that really what you need to focus on, even though the stock was moving so quickly, was go ahead and establish what the pre-market high would be. And the pre-market high on CWD was $56.06. So that would be the level. And I checked it before I came on here, guys. We haven't even come close. We saw that level, the market opened up and there was a big sell-off. The second one, STEC above 715, MMA above 555. Now, the other thing I just want to remind everybody, and Roger says this all the time, remember when you're looking at small cap stocks that they're basically on an island of their own. Really, they're not impacted by what's going on in the broader market. And his selection process is totally focused on price action and volume, okay? Number two, he always reminds us only trade these during the normal market hours. And if the levels haven't been achieved by 2 p.m. Eastern time in the afternoon, move on. Don't chase that. Don't worry about that. There'll be more opportunities the next day. Lastly, Roger asked the question if anybody would be interested in a special class or even a program that he might build around how to buy and sell small caps. And I think overwhelmingly people said they would be interested in that. So I know Roger's going to take that under consideration. Now, with regard to stocks that Roger was looking at, let me go ahead here and share with you the stocks that were on Roger's short and long list. And I have just a couple of quick comments about that. On the longs, if you look at MU and TSM, Roger said, look, guys, if you trade both, it's a 1/2 serving on each. In other words, these are correlated stocks. And so if your normal position is like $1,000 and you want to trade both of those, don't put 1,000 into each. Put 500 in one and 500 in the other. You know how Roger feels about being careful about, going all in on stocks that are correlated. Also, with regard to these stocks, remember, folks, Roger's advice is that make sure that if you go long or short in them, be absolutely sure that they are breaking out or that they are breaking down. So, final comments from Roger today. He expected things to be seasonally slow. It's September. He didn't see any major catalyst. He said the market's going to be focusing on PPI and CPI data that will be coming out later this week. He expected a low volatility day, not really expecting any craziness. He did note that sector rotation seems to be favoring interest-sensitive spec sectors because, once again, there's a 100% chance right now priced in the market that we see a rate drop in September. He did note that the SPY, the QQQ, SMH, IWM, Dow were all drifting higher in their ranges, but he said, guys, be careful, keep an eye on the bonds, because to see if they hold or if they're going to drop below support. And if they do, it's going to have an impact on small caps and blue chips. So I know we're getting ready to start. Roger's got a great agenda for today. He's going to be sharing part 2 of credit versus debit spreads. He's going to tell us how to set up an iron condor, which is a two-sided credit spread. He's going to give us the best technical levels for credit spreads and iron condors. He's going to share why iron condors give a 2-for-1 margin and risk requirement. And I think this is great. He's going to share with us, how do you manage a credit spread in iron condor if it's going against you? Critical information. And out of the mailbag, he's going to share how to exit small cap stocks. So with that, I know we're getting ready to get rolling. Matt, Roger, always great to see you. Welcome, welcome, welcome. Roger, very, very interesting session this morning. You know my question. Any surprises today so far?
Great question, actually. Real good, real good question. To be quite honest with you, absolutely zero. Zero, zero, zero. Absolutely nothing. Nothing at all. Very much as a matter of fact, very much like we expected it. Very much like we said this morning. As a matter of fact, look at the SPY. Remember what I said? Just kind of hover around the 8-day MA. I'd like to see us make a higher high. The meat of the move is not there. We're above the 8-day MA. Absolutely exactly what we expected. By the way, interestingly enough, look at how we came. Look at my levels, Raleigh. This is crazy. Look at the levels on the high.
Oh,
And
yeah.
look at that. Yeah, obviously we did not draw them after the fact. Those were the same levels I posted this morning
Absolutely.
on uh on oh, hey Rochelle, how are you? I haven't seen you in ages. I've been emailing you and I haven't received anything back. Rochelle is back. Good to see you, Rochelle. Good to see you. Let me just say hello to everybody here and we'll get started. We got Richard, we got Rochelle, Kevin, John, we got Devin, we got James, we got Steve, we got Edward, we got energy. There we go. We got energy. And here we got. I got to say hello to the folks. I haven't said a good morning to you in a while. Ken, good morning, Ken. Good to see you. We got Steve. We got Peanuts. We got Bugs. We got Jill. We got Alan. We got Kristen. We got Go Bucks. Can the morning show be put on the website? I don't know, Go Bucks. I'm not sure. Maybe it actually is. I just don't. I use the YouTube, but it could theoretically. Raphael, Cyrus, Ken, Robert, William, Cyrus, Ken, Kevin, Andrew, Edward, Ralph, Jill, Wesley, Chris, Ivano, iPhone, Kirk, Jeremiah, Vernon, Flying Ronan, Ted, David, Norm, Rock, Barbara, Annie, Maggie, Joel, HG. How are you? Pink Sparkles, Val, Mike Lai, Scott. Sorry if I'm missing some of you. I'm just scrolling through. Liberty Zoom user, OTI iPhone, Kristen, Marina, DJ Vernon, Spider Monkey, Chris, Mary, Kelly, Jim. Hello, greetings, everybody. Greetings, and on YouTube, I already mentioned everybody on YouTube. No, absolutely no surprises at all, Raleigh. No
Yeah.
surprises at all. I
And
wish there was a surprise. Underwater basket weaving session. You know,
well, you know what was interesting watching the markets, as you said, Roger, you said watch the bonds. And right at the open there, bonds were moving lower, and then they kind of stalled. They just kind of stalled and they're sitting here sideways, trading right about 89, 19, somewhere in that range. But I was going like, uh-oh, bonds are falling off. Are they going to drag everything else down? But they kind of slammed on the brakes. And I don't think they broke through that critical area of support.
they did for just a little bit,
Just a hair?
for a
Okay.
hair, like right here, just like VIX. Look at VIX. See that?
Yeah.
Remember, I said the same thing for the VIX. A little later, I drew something on the. I gave us some levels, but very very quickly broke it here and broke it here. But these are micro levels. These are not the same levels you're talking about. These are levels I put on. Here, let me show you what I'm talking about. You and I are not talking about the same thing. You're talking about something I talked about this morning. I'm talking about these levels right here. Hold on. Oh, I have them right here. Ah, here. This is what I'm talking about. See, I
Oh, I
drew
got you.
later on in the day around 9:45, about an hour and a half after the morning show. I came here and to the trading zone, and I drew these levels right here,
I
and
got
I
you.
drew this
Yep.
level right here, and I said, keep an eye on these two things happening, and they both happened, but they happened for about, I don't know, 10 minutes, 15 minutes, and then they
Hmm.
were back in line.
Hmm.
This came back and this came back. They're very much related right now because everybody's looking at interest rates. And the reason and by the way, but the most important thing, the catalyst. See, folks, this is really important. It's really important for you guys not to just look at price action, but to understand what caused this move. And if you used hard stops right now in your positions, you would have all been stopped out. Okay. So let me give you a lesson here. We knew as this was happening, actually, the reaction wasn't even that fast. It was like a 20-minute thing.
Hmm.
Basically, the crux of all of it was there was some talk about a government shutdown. Okay. Now, logically, think about this right now. We just started talking about it right now, right? Okay. We don't know anything about it. We don't know when it's going to happen. We don't know if it's going to happen. The odds of it happening are almost nothing. And probably after it's been said 10 times, this effect will not even be seen in the market. This is like the first time effect. So Matt and I were looking at each other. We're like, okay, there's chit chatter on the wire about the government shutdown. So we're looking at each other. We're like, yeah, well, it's not meaningful. It doesn't mean anything. It's just those are algos just doing their job.
That's
But
right.
the algos don't know. The computers don't know that, hey, a all that stuff that I just said about the government more likely not shutting down, the fact that it's just starting to happen now, that this talk. So it's obviously there's a lot of sensitivity to it, just like there was a lot of sensitivity to tariffs when Trump started talking about it. God knows when, beginning of the year, and all that stuff. So the point I am making is you you have to know by either by trusting me, by coming here often enough to start figuring it out, or by using common sense. Now, here's the interesting thing. I'm going to tell you tomorrow or later today. and I can't prove this, but I'm pretty sure there's going to be another news, and it's going to say exactly the same thing. It's going to be this. It's going to be repeat because this thing just started. It's a buzz. It's buzzing right now. It's hot. So, and you know what's going to happen? The next time it's going to it's going to do this. Let me show you here. So this time it did this, right? You could see my screen. Yeah.
Yeah.
Well,
See, your
yeah. Okay.
screen's just great.
Okay.
Yep.
Cool. Cool. All right. You could see my screen. Next time the news comes out, it'll be this. And then the following time, it'll be this. And obviously, I'm being literal, but you guys understand what I'm saying.
Mm-hmm.
Because we don't know anything about it. It's so speculative. It's so out there. So you can't just treat all moves like they're the same. You can't do that. Now, if you don't know better, I get it. But generally speaking, this is just it doesn't carry any weight. It's like somebody coming going, ooh, okay, great. It's like when you're driving in the bus. It's been so long since I drove in LA. When the bus came next to me in LA, I would move to the side. And I realized, like, what am I doing? I'm making an ass. It's just the way people drive in LA. They drive close to each other. So don't get scared off. And if you have a news service like Trader Exchange, which is what this guy here uses, who stole it from me, because I bought it for myself, and he you see those headphones he's got on? He's got it in his ear, and he needs it because he's trading the SPY in the trading zone, so he needs it in real time. So I'm just like, Matt, what's happening? And he'll tell me right away. And that's fine because it saves me from having it on my computer. Basically, he's like my filter. Right, Matt? You're my filter.
We would have to figure out how to fit even more screens in that space.
Well, actually, it's funny. Here's what I was thinking of doing. And I actually was thinking of doing this. I was thinking of taking two monitors, like the monitor we have here, the TV.
Mm-hmm.
I was thinking of taking two monitors and getting that thing that duplicates the screen, just duplicates it, not different screen, but duplicates the screen on another monitor. And that way you have one rolling by you and I have one rolling by me. I keep thinking of that, but I haven't, these are the things that I think about. These are the things that I think about during the day, folks.
You guys are going to look like a NASA control center.
I don't know. Have you been here recently? It already is. We have
I have not, Roger. Every now and then I get a glimpse of, behind the scenes, and it's not all palm trees and beach.
No, there's a lot of stuff going on here, and we don't have
15 monitors in here.
How many, Matt?
15.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13.
You guys are secretly mining Bitcoin. That's what you're doing.
See, actually, it's actually like 17, but who's counting?
Wow. There you go.
Yeah, it's a lot of monitors. That's why I have to open the room.
I was going to say every now and then.
Let me show you guys something. Let me show you something, Raleigh. Hold on. We also have torture techniques in this room. See, every time Matt misbehaves and loses money on the S&P trades,
you hook him up.
Oh, yeah, you see this? You see this, guys? See this, girls? He gets it straight from here.
Man, it's Pavlovian.
Oh, yep. I'm pretty strict. I'm pretty strict around here. We don't mess around here. All right. Now I'll tell you guys, before you go out and buy 10 monitors, let me just tell you this, that statistically they say you're the most productive with 3 monitors. Okay, just so you know. And it may be true. It may be true. I'm envious of people who can make that work. I'm not one of them. Okay. All right, let's continue. Okay, so yesterday we talked about credit spreads, and I explained to you how we look at the ratio of the price of the asset versus the risk of the asset. And we talked about how anticipatory versus confirmation trades, and we talked about liquidity. Okay, so I want to show you some examples of iron condors and some of the tools we use to determine if it's a good time to put an iron condor on versus a credit spread. And
Outstanding.
yeah, and I don't want you guys. I don't want you guys. Uh, I really do not want you guys to get. When I say the word iron condor, it may sound very. It may sound very like, what's an iron condor?
Sounds exotic, you know?
Right, right. It sounds like woo, but an iron condor is just two credit spreads. It's just two credit spreads. That's an iron condor. You're basically doing a credit spread on the put side, and you're doing a credit spread on the call side. Now, the question may be, well, Roger, what's all this credit spreads? Why would you do that? Hmm. Let me show you why. Let me show you why. Um, so say you have an asset like this. Like this. Okay? It's a pretty good example of what we're talking about right here. Okay? Nice squared away. For all we know, price can continue moving like this for the next 3-4 months, right? Well, you could do a bear call spread right here, and you could do one second. I gotta do something here. One second. All right. One second. All right. Sorry about that. I had to peel off a little bit of a position. Sorry about that. I apologize, folks, but I am doing this in real time. I'm not just like sitting here and playing with
No,
Clyde. I'm
this is
actually,
definitely live, real
yeah,
time.
yeah, yeah. I got it.
Multitasking.
One more second. 7. Okay, there we go. I was waiting for that. Boom. Okay, there we go. All right. I needed to close Amazon, and we closed Amazon, and we made about $1.10 on it, $1.20 on it overnight. Oh, it's still running. So I had it right here. So 30. Yeah. Okay. All right, guys. Now I can focus on you 100%. All right. So let's say that a stock stays here for a foreseeable future. It's just choppy. Okay. Just choppy. All right. Well, if it's just choppy like this, you can sell a bull put spread right here and a bear call spread right here, and you can take money on both sides. Now, you may be asking me, or you may be asking yourself, well, what? Okay, I get money both ways. That's great. That's great. But do you want me to tell you guys what really gets me excited about this? Really, really gets me excited about this is that your margin, your risk, and your downside is only one side. Is only one side. Okay? So, well, what does that mean? Well, let me show you something. Let me just use something that has a little more oomph to it. Let's pick let me give you something that may actually work, okay? So take a look at BBBY. I'm not sure you're probably thinking, Roger, didn't this stock go out of business? It did. It was repurchased. It was repurchased by another company. But they kept doing it. So it did go out of business. But let's see here. All right. So for example, you see this right here? Let's say that we theorize that this stock is going to stay in this range right here. Okay? Okay. And let's say that I think that it can't go above this and it can't go below this. 950, let's just say 950 and 1150, okay?
Mhm.
Just to make it easy, okay? Let's take a look at our options. Not that liquid, but there's some liquidity here. Let's just first start at the puts. And let's do here, let's go to the strike price. Oh, these things have no liquidity. I'm going to have to do something else. That's the problem with these things. A lot of times they don't have good liquidity. This has good liquidity. Okay, let's do this. Irene, okay? There. Perfect. Oh, perfect right there. We got a nice VWAP, a quick strike trade going on right here. So let's just say that we think the stock will not go below the A line, the 8-day EMA, and it won't go above the high here. Okay, simple enough. Oh, let's just go 17 days out, and let's just say here 25. All right, let's do this here. We'll go 25.50. Or how about this? How about this? 26.50 versus 25.50. Okay. We would sell the 26.50 and we would buy the 25.50 in case all hell breaks loose, right? We don't want to be naked. And it says 101, 164, but let's just say this is 50 cents. It's probably closer to 50 cents when it's all said and done, okay? So our risk here is $1, right? 25.50, 26.50 is $1, and we took 50 cents. I'm trying to, we're not going to do this trade. I'm trying to be conceptual using an example. So
Right.
you don't necessarily have to write down or get me down to a tick. Just try to understand the big picture, okay? So our risk here is a dollar so far, and we took in 50 cents, okay? Let's now go to the call side. Well, let's assume that we like this trade, but we don't think it's going to go much higher than the high. We think the market's choppy right now, blah, blah, blah. Let's say that we don't think it's going to go much above 30, okay? So we go back to let's go back to our 17 days out right here. Here's the calls, 28.50. Right here, 27.50 versus 28.50. Or you know what? Let's go a little for let's go 28.29, okay? 28.29. 190.243. It's about 50 cents. What's our risk here? It's $1, right? Okay. Well, let's say I'm the head of the margins department, okay? Let's say I'm the head of the margins department at Thinkorswim, okay? Which is actually a pretty fun job, believe it or not. I actually know not the head guy, but the guy behind the head guy at Thinkorswim. He's a pretty cool guy. You should hear some of the stories that I hear, but I digress. So if I'm a margin guy, how would I? And let's say you have $5,000 in your account. So walk with me through this trade. Walk with me through this trade. Okay. And by the way, this is not a bad trade that I'm giving you here right now. I'm just saying, especially if this just stays in this area, which it probably will. So let's just take it one step at a time. If we're doing the put side, we're risking $1, right? We're risking $1, and we're taking in 50 cents. So for every dollar, we're doing 50 cents. That's right, Bob. 28.29. 28.29, and then the put side, I think it was, I don't even remember what it was now, but it was 50 cents. So if we say we want to take in $500 in premium, right? We would have $500 of risk. Our max loss is $500.
It's 500.
It's impossible. Matt, can you do me a favor? Open up this. I promise. I won't do this to you. Just use this to open the door. Thanks. This is what we used to hold the door open.
Door stop. Yeah, there we go.
Yeah. Thanks. I appreciate it. All right. Just trying to bring a little light humor So how's that stock doing that you just put into A-line, by the way?
Seven.
7%. Okay, great. Cool. Okay, so let watch this. Watch and learn, because when I learned this, I was like, wow, that's pretty cool. I never knew that. So let's say I'm a margin clerk. I'm the bad guy. I'm the guy that calls you and says, you got to put more money in the account or I'm going to liquidate your butt. Okay. Can you imagine you get a call from a margin clerk and it's me calling you? That would be the craziest thing ever. That would be like April Fool's Day, right?
Yes, it would.
That would be funny. That would be really funny, actually, now that I think about it. Um, so $500. Okay, well, Roger, you know what? It's 50 cents. I'm gonna do 10. I'm gonna do 10 spreads, $50 a spread, 10 positions. I'm gonna risk $1,000. I'm taking $500 in, and it's not a trick question. I'm giving you the answer. It's $500 margin. So I want to make $500, and I'm gonna risk $500 to make it. I'm gonna risk 1,000, but I can keep 500 of it. So you'll make 500, and there's a chance you could lose 500. Okay. Now, listen to this part of the equation. What about this side? Well, hey, it's the same thing. You took 28.29, it's $1 risk, and it's 500 you're taking in. So, okay. So what's my risk? It's $1,000 minus 500. So it's 500 there, 500 here. Is that correct, folks? So is my margin $1,000 because it's 500 here and 500 here? My max risk is 500 here and 500 here. And if anybody knows the answer, don't say it. So my margin should be my max risk. My max risk is $1,000. So shouldn't that be my margin? Let's see if people here listen to what I've said before. And I don't want to hear from you, Ken. You're a post-PhD in math. You don't count. I don't want to hear from anybody who knows or remembers everything I say. Look at that. Michael says Michael doubles it. He's like $2,000. No. Okay, does anybody know why? Okay, why is it $500? Show offs. Why is it $500? I'm having so much fun with you guys today, honestly. Okay, that's right. I'll tell you why. And a lot of you don't know why. And to be fair, a lot of people don't know why. Because the stock cannot be at two places at one time.
At once. Yep.
It can't be at two places at one time. So what your broker what your broker always does is you win one side and lose. No, Stephen, no. Let's say the stock. I haven't got to that yet. Let me get to that. So Michael, it's not $2,000. It's only $500. Okay. It's only 500. Remember I said risk is 500 here and risk is 500 here. And then I was trying to trick you and say, so it's $1,000, right? And what people should have said was, no, it's not. It's 500, which folks exactly did. So David, we got out of Amazon already. We took a profit on Amazon. I gave that out a little while ago. So let me continue this. This is interesting stuff. So let's look into this for a second. Number one, the stock at expiration cannot be up here and up here. It can only be at one price. Therefore, what the margin guy will do, and I gave you an example. So let me tell you what the margin clerk will do. Okay. What he does is he uses the greatest risk side. Well, what do you mean, Roger? It was exactly 500. Well, in our example, it was 500 and 500. But let's say in real life, let's just hypothetically say in real life, on one side, you took in $501, okay? And on the other side, you took in $499. And let's say everything else is the same. And in our example, everything is the same except for that. In other words, the spread is $1, and here the spread is $1 between the two strike prices, right? That's the spread. So he would risk. So what he would do is he would take he would margin the side that you took the least amount of money in, the $499. So he would ask for $501 instead of $499 because he wants to secure his biggest side. He understands it can only go one way, but he doesn't know which way. So he's always going to take his biggest side. Now, again, in my example, we were living in the perfect world and each side was $500. But in a real world, they're never going to be exactly the same. I mean, they could be, but even if but sometimes if you say, hey, wait, what's going on? Why are you taking more than half? Well, they're always going to take the risk on the biggest side. And the odds are you're not going to bring in the exact same amount of premium. Now, let me go back to the trade. Somebody asked a great question. So you could lose money on both, or what happens? No. Here's where it gets fun. Let's say you're not paying premium, Mike Cly. You're taking in premium. You're being a bookie. You're taking a bookie. So now somebody asked a great question. Basically, they said, well, wait a minute. So you make money on one side and you lose money on the other side. Not necessarily. If the stock on our expiration day, whichever that day may be, closes below here, let me draw it for you. Below here and above here.
So it stays in the range. Yep.
Stays in the range. You keep both. And you can, and also, okay, so you'll definitely keep one side. That's a given, right? But look what you could do. As it's going up here, let's say that, hypothetically speaking, let's say expiration is 17 days from now. And let's say the stock starts going up here, really high up. We cut off, we take a nice big fat profit on our put side. And unless we think it's a real breakout, if it's a breakout, we just close the whole trade. And most likely, whatever we make here, we'll lose here and it'll just be a wash. But what we could do is, if let's say I think the stock is just going up to a range and doesn't have volume and I don't think it's going to be a breakout and the market's not cooperating, what I'll do is just simply cut off the put side here. Or let's say it's moving up from here. I'll go ahead, take my winner right here, take a nice big fat winner here, wait till it comes up here, and then as it starts coming down, take my winner up here. Just take them at a separate time. You understand?
Mm-hmm.
The point is you have a lot of flexibility. You're taking in twice as much profit potential for the risk, and there's a chance you can keep both. Also, let's say it closes right here. Well, I'll make 500 on one, but I don't have to make 500 on the other one. I can maybe make 300 or 200. That's okay. It doesn't have to be all or nothing. It takes a little while for it to eat into our profit. And again, I'm usually doing these like 17, 20 days away. So in that 20 day, there's a good chance we can come up and come down. A real good chance, especially if a stock is stuck in a range and you have high volume bars above here and here. So let me now go on to it's a great strategy. Roger, how come you don't do it all the time? Because I like to pick stocks that are moving, and this is using stocks that are not moving. So what I do is I like to find them very, very sparingly, and like to use them very, very sparingly when my confidence rate is just through the roof, or after earnings on large cap stocks like Tesla, Nvidia, Google, because their implied volatility is so darn high, we can go a little further out of the money on both of them. Like instead of doing this, we can do this. If that makes any sense.
Yeah.
Kind of like all the way. You guys get what I'm saying. We can take less risk. We can take less risk, or we can get more money for the risk we're taking. I hope that makes sense.
Sure.
So,
hey, Roger, real quick question here.
Yes, please.
Is there a situation where, for example, the market makers can help you on that range selection?
Yeah, well, what you could do is this, and again, I just wish I had more time in the day. But
yeah, don't let me distract you here. But
no. I'm trying to answer your question. You asked a good question. That's not what I mean. What I mean is, I wish I had more time in the day to do what you're talking about right now.
Okay.
I wish I had more time. Let me explain why. So what you could do is, let's say you have a good support and resistance area.
Hmm.
You can watch the stock, right, throughout the day, wait for the stock to get there, do the bear call spread, then again wait for the stock to come down here, literally time it on an intraday basis and do that, and then you have two sides. Basically, the way I describe what you're describing is the opposite of what I just described for taking profit. We can enter leg into it that way as
I
well.
gotcha.
So
Gotcha.
what I'm trying to say is I wish I had the time in the day to do what you're suggesting.
Hmm.
So it
Okay.
would be useful. Now, there's another way that you can interpret your question. Can the market makers help? The answer is yes, when you do both of them together at the same time. When you do the put side and the call side as one. I think it was Michael. Michael says, doesn't the iron condor provide one total price? Yes and no. You could do it as two credit spreads,
Right.
or you could do it as one iron condor. You can, Michael. You can. You're not wrong there. You're not wrong there. And yes, you can save a little bit of money, but you lose the control and the control of what I was just talking about,
I
which
see.
of
Yes.
being. So what I meant when what I meant, I wish I had time. I wish I had time in the day. I wasn't blowing off your question. What I was saying was I wish I had the time in the day to apply what you were suggesting. That
Hmm.
would be. I wish I had. I wish I could do that because it would give me that precision. You know what I mean? But
Yep.
usually I do that on exits. But yeah, you could do it on it. Like for example, and Raleigh just opened up a beautiful can of worms. You can go say 3 weeks out, like go 24th, right? That's 24 days out. The odds are, and again, let's just stick with this example. The odds are over that 24-day period, there's a really high chance that this stock will go up here and come down here. I mean,
Mhm.
that's not like saying anything crazy, okay? I wouldn't put my money against that happening, okay? So you kind of just wait for it goes up here instead of sitting here and say, okay, let's do an iron condor. Let's just measure our distance halfway through. You could do that. You could do that, but you'll get a half of what you would get if you would do what Raleigh is suggesting. And again, I wish I had the time in the day to do that. But what you could do is you could wait for it to come here, see if it hits the resistance right here,
Right.
mm, do a beautiful close to the money or right at the money credit spread, and then wait till it hits right here. Wait till we go down here and then do a put, and you'll get like optimal pricing for this, and you'll get optimal pricing for this, and 80% of the time, you know where it'll close right in the middle.
Right in the middle. Yep.
So because it's not trending right now, it's not in motion, and that's kind of what you want. So yes, what you're talking about has a lot of validity, and I just wish I had another set of eyes behind my head to
Yeah.
implement that during the day. You know, that's the only problem there. So I wanted to just move on to something a little something else that's relevant here, and that's how do you identify a good time for an iron condor versus a debit spread? Well, as I explained yesterday, and I'll just kind of go into it again today. The way I treat credit spreads, not debit spreads, excuse me, iron condors versus credit spreads. The way I treat credit spreads, and we'll have a presentation about this in a few minutes. I don't do credit spreads like most guys out there. Most guys out there will be like, okay, here's the support for this stock, Irene. The odds are over the next 2 weeks, Irene will not go from here to here. And how much can we make? Well, we can do a 20-1. We can take 5%. And you know what? Let me just say something. It works. It works. It really works. That method works. It works really, really well. I'm not a butterfly guy, Omar. I've never been a butterfly guy. Iron condors are as advanced as I go. I've never seen it too much, too many sides. Too much stuff can go wrong. I'm a believer in keeping things simple. I know you probably don't believe me, but I am. I keep things I'm a bread and butter kind of guy. And I don't even eat butter. Um, so, so, so the way most gurus do credit spreads, and we'll talk plenty about this in a few minutes, but the way most gurus do credit spreads is they do a 20-1. Yes, Stephen, that's exactly what I mean. It's exactly what Stephen just wrote. Let me just Raleigh,
Yeah,
repost what
I'll
Stephen just
repost
wrote.
that. Yeah.
That's exactly you got it. That's exactly it. A 20-1, meaning they're going to be right 95% of the time, but they're going to take 5% credit. Okay? That's what they do. Now, again, it works beautifully. It'll work 19 times, and on the 20th time, you lose everything you made. It's called walking up the stairs and falling down. Okay? The way I do credit spreads is I go right here and treat my credit spread like it's a directional trade. And now I'm looking at it from a directional perspective. And to me, this looks like an A line. That's a VWAP above here. So I'm going to do my credit spread, not here. I'm not going to take premium here. I'm going to take premium here. So they'll take premium at 15 and hope to God that it doesn't go to 15. I'm going to take it right here. And I'm going to get 50 cents on a dollar instead of 5 cents on a dollar.
Yep.
And I'm telling you, that's the way most professionals do it. And it works 19 out of 10 times. It does. Going up the stairs and falling down. Exactly. The way I do it right here. I used to do it this way. That's how I know. And I didn't like it. I was like, this is making me This is making me feel very uncomfortable. Because you know what? It works till it doesn't. You know what I'm saying? It's one of those. It works great. Oh, what? And then people will be calling me a moron. Be like, dude, you took a 19-1. Why would you do that? And I didn't have a good answer for that. So I'm like, I don't like 19-1s. I like 1-1s. 1-1s I like. So I'll go not here. I'll go all the way up right. I'll go breathing down this thing's neck because I think we have a turning point here. And even if we don't, let's just say it just stalls out right here and my option is here, I'll still make money. So I don't care. But I'm trying to get 50 cents on a dollar. My goal is to get 40 to 60 cents on a dollar. So that's how I treat one-sided credit spreads. But how do I treat iron condors? And when do I look for iron condors? So if you want to know how I look for my credit spreads, the A lines, the stealth surge, 90-day breakouts, the way I do all my trades. But what about iron condors? Well, iron condors are totally different. What I want to see in an iron condor is something like this. I don't want to see a breakout. I don't want fast-moving stocks. I want the 15 and the 8-day moving average to be like this on top of in between all the price action. I don't want the price action to be above the 15 and the 8. I don't want the 15 and the 8 to be opening up. See, didn't know I could do that. See, I don't want them doing this. I want them like this, on top of each other. I want the crocodile's mouth to be closed, not open like this. See how it's opening up here? I want it closed like this. When the 8 and the 15 are on top and below and you don't know what's going on, that's when you do iron condors. Okay? That's when you do iron condors. You don't do iron condors on a market that has a slope. You don't do it on a market that has rotations. You don't do it on a market that has strong energy. Now, believe it or not, and I know you guys believe me, there are stocks that sit like this, literally sit like this, and have an average range of like $15, $20 a day. Okay? So yeah, Hefe, exactly. You want to be when the 15 and the 8 EMA, and I don't care if you use EMA or regular MAs, I want them to be just sitting on top of each other. When they start opening up, that's not good for iron condors. Okay? That's not good for iron condors. So again, let me just review. And if you guys are interested in more in how I do credit spreads versus how 99.9, actually, I'm the only guy that does credit spreads like this. I've never seen any other guy do credit spreads a different way than me. I mean, I've never seen him do the same way as I do, because most guys that do credit spreads or specialize in credit spreads, they do them because they're not good market timers. I'm doing credit spreads as a market timing tool. Yeah. I'm using so it's a very, very, very different perspective. Again, let me show you. Just take Amazon, okay? If I was a credit spread writer, okay, a regular one, I would be trying to do Amazon right here at 219 because I would assume that Amazon is not going to go below 219.
Right.
Okay. You know where I would do an Amazon credit spread? Right here. I go for the jugular, but I try to get 40 to 60 cents. Now, here's where things get real fun. Do the math. Let's say you're 75, 80% accurate, right? And let's say your risk to reward is 1-to-1.
It's incredible.
1-to-1. Because why is it 1-to-1? Maybe it's a little less, a little more, but it's close to 1-to-1. But my win rate is not 50%. It's between 70 and 80%. 1-to-1. Why is it 1-to-1? Because I'm taking 40 to 60% premium every time I do it.
Every time.
And my risk is defined of the spread. So Roger, what if you do a debit spread right here, like you say, right? And Amazon goes to 100. 100 from 240 to 100. So my risk is the difference between the one I bought, one I sold, minus the premium I took in. Mm-hmm. So let's say right here that my risk is $2.50, $250 minus the premium I took in. So if I take in $150, that offsets this. I'm always trying to get 40 to 60%. 40 to 60%. So think about this. Just think about it right now. Risk to reward, 1-to-1, 70 to 80% win rate.
Win rate. Yep.
Plug that into your expectancy formula.
Yeah, and once again, guys, simply, let's look at 10 trades. All right. In 10 trades, 7 winners, 3 losers.
Right.
7 times 50 versus 3 times 50.
Simple math.
Very, very simple math.
Very, very simple math. Versus going here and taking in like 10 cents, right? And having a 9-to-1 or a 10 to not a 9-to-1. I thought it was a dollar.
Yeah.
It's 24 to 1. 24 to 1. 24 to 1 because this is $2.50.
Yep.
I thought it was $1, so I'm thinking 9-to-1. No, 24 to 1. 24 to 1, 1-to-1. Now, you're thinking, well, this sounds pretty interesting. I like where he's going with this. So now if you want to learn more, now this is the last time I am doing this, and this expires at midnight. This is it. This is the last day. We don't have a lot of spots here. This is the program that I'm going to tell you the whole story of why I changed it, how I changed it. I'll give you the whole thing. Raymond's asking a good question.
On assignment?
Raymond's asking a good question. Risk of assignment. So most of the time, no. I mean, yes, there's a risk. There's a risk. But let me explain to you something. And folks, take a piece of paper and a pen and write this down. Okay? Take a piece of paper and a pen, write this down. Why would somebody exercise a position against you? That's how you got to start asking yourself the question. Why would somebody exercise a position against you? The only incentive they would have to exercise a position against you is if they can, by exercising the position, they can go in the money and get the position for cheaper than going to the market and getting it. It's all about dollars and cents. Would you agree that the only reason they would exercise a position is if they can take it from you for cheaper than buying it at the market? Otherwise, why not just go and get it at the market, right? So the only time a position is cheap, the only time they can do that, buy it from you cheaper, which is what it's called exercising. It's buying it from you cheaper than versus going into the market. That's what exercising is. The only time that it's equitable for them is when there's no premium on the option. Because if there's premium on the option, then they're paying premium instead of going to the market, you see? And the only time that happens is when the option is really deep in the money or an hour or two before expiration. We try not to hold an option an hour or two before expiration, and we try not to hold it when it's too deep in the money. You're pretty much immune from exercise when your option has premium. And I know when our options don't have any premium. When does it usually happen? 1 in 15, 1 in 10, maybe 1 in 20. Doesn't happen often. But if it does happen, you have a button called auto exercise. Remember, you have a position too, your hedge, and you can exercise, and they just hedge each other. They close each other out. Okay.
Outstanding, Roger.
Okay. No, Stephen, it wasn't the Carvana. Carvana was the first or second trade in the program. It was when Brian called me about the AMD trade. And I'm going to talk about that trade here. I'm going to give you the whole story about it. I'm going to explain to you how I went from one method to the other. I figure by giving you this backstory, you guys will have a much better understanding of what I'm going to show you right now. I'm going to actually give you numbers, show you examples, show you the before and after. Now, as you go through this, keep in mind, this is the last day I am having it. Matter of fact, this is the last webinar I'm having this probably for the next quarter. I don't do my scheduling, but they usually give me this once a quarter.
That's right.
If you want to save good money on this, like a lot of money, this is a good time to take action. If you want to learn the right way to do credit spreads without what I call walking up the stairs and falling down, this is a good method. And if you took a little profit on Amazon, send me a nice email and say thank you. Now, folks, there's no monkey business around here. There will be losers. There's